Welcome, Beyond the Fringe Show. I'm your host, Tatiana Zalan, and I go live every Friday at 2 p.m. Dubai time. The Fringe helps you to understand the rapidly changing world and increase the odds of your success. Here we discuss technology, entrepreneurs, startups, and mental models of successful people so that you too can take advantage of the opportunities in the new digital world. Today is my show number 29. It's an update on CBDC. If you want to check out, there is another video that I posted some time ago on central bank digital currencies or CBDCs. What will happen with CBDCs in 2022? What is the innovation? Is this the innovation that will help probably with the adoption of cryptocurrencies like some people would believe, or is it nothing less than a tool for government control? And in this episode, I will be focusing specifically on a very long anticipated white paper by the Federal Reserve, which is called Money and Payments. There are lots of misconceptions surrounding the central bank digital currencies. And just to illustrate that, I've got here a paper from Ripple, the company that owns XRP, developed XRP, one of the top 10 cryptocurrencies. And they call this paper The Future of CBDCs. And one of the first statements that they're making about CBDC is what is a central bank digital currency. And they're saying a CBDC is the sovereign equivalent of private cryptocurrencies and digital assets like Bitcoin, Ethereum, and XRP. It would be issued and controlled by country's central bank and used by people and businesses for retail payments, much like cash, but in digital form. CBDCs will also be used for wholesale settlements in the internet bank market. It's a very confusing statement. For starters, XRP is not like Bitcoin and Ethereum. It's heavily centralized. And well, we will see what exactly the design of CBDCs will look like, but generally it's a very misleading statement. It's not necessarily equivalent of digital money at all, much like cash, but in digital form, very far from it. And this is precisely why I wanted to make this show. Who is the show for? I think it's the show for that particular episode for every global citizen or business person, particularly if you're probably working in the commercial banking sector. Let me remind you, it's a live show, so please let Facebook to identify you. And everything that I'm going to talk about is not to be constituted as financial and investment advice. I am not your financial advisor. All that is for informational and educational purposes only. Now, just to give you a little bit of an overview, what is happening on the CBDC front, there are a number of countries that are launching or very close to launch of CBDCs. The two countries that already allegedly use CBDCs are Nigeria and the Bahamas. Jamaica has recently said that they are launching their CBDC, the central bank there, made this statement. After 8 months of trials, they're finally ready for a launch. China, of course, has been very active in the space. I think the first time when I heard about the digital yuan was something around late 2019, early 2020. And it's hard to know what's actually going on in China, but my sources, which are unconfirmed altogether, said that they rolled it out and then suddenly had to pull it back because somehow it didn't work out. However, it's not confirmed. And now that they're saying that they're going to launch their CBDC, the digital yuan, for the Olympics. And they're very careful saying that it's going to be used for online and offline shopping, for paying some bills, transportation fares, and it is not going to replace the US dollar as a reserve currency. They're very careful at saying that. Then there is also Kazakhstan and Russia are making noises about CBDCs, and Brazil as well. So quite a few countries on the verge of launching CBDCs. Now, let's turn our attention to this very seminal white paper. It's up for discussion, which is called Money and Payments, the US Dollar in the Age of Digital Transformation. A very important paper, much anticipated, and it's by the Board of Governors of the Federal Reserve System. Of course, it's headed by Jerome Powell, the head of the Federal Reserve Bank. There were some problems with the release of this paper, because at first they said they're going to do it in 2021, then at the end of 2021, then finally it is ready. So it has been delayed several times. And the Federal Reserve here is exploring the implications and, of course, options for issuing a CBDC. How do they define CBDC? Very different from the Ripple paper. A CBDC, they define it as a digital liability of the Federal Reserve that is widely available to the general public. And by the way, the reason why we're so interested in the Federal Reserve paper, and generally whether the Fed is going to release a CBDC or not, is because, of course, the dollar is the reserve currency of the world. Americans currently hold money predominantly in digital form, so this is nothing new. For example, in bank accounts recorded as computer entries on commercial bank ledgers, but a CBDC will differ from existing digital money available to the general public, because a CBDC will be a liability of a Federal Reserve, not a commercial bank, and I think that's a very important difference. The paper starts very well with explaining what types of money exist in the system and how CBDCs fit into the existing system. So the first type of money is central bank money, which is the liability of the central bank. In the US, central bank money comes in the form of physical currency issued by the Fed and digital currencies, which are held by digital balances, rather, which are held by commercial banks at the reserve. And physical currency has this legal tender status in the United States. So that's the first one, central bank money. The second one is commercial bank money, and it's the digital form of money that is most commonly used by the public. Commercial bank money is held in accounts by commercial banks. And finally, there is non-bank money, which is digital money held at balances at non-bank financial service providers. These firms typically conduct balance transfers on their books using a range of technologies, including mobile apps. So companies like Visa and MasterCard and Stripe and PayPal, all of those will be probably fitting into this non-bank money category. They, in this paper, they also discuss the benefits and risks of a CBDC, probably more about benefits they talk than about risks, but we'll get to risks as well. So as CBDCs can potentially offer a range of benefits according to them. It could provide households and businesses very convenient electronic form of central bank money. It gives entrepreneurs a platform on which they can create new financial products and services. It supports faster payments, faster cross-border payments in particular. It expands consumer access to the financial system. They will not require deposit insurance to maintain public confidence, and will not depend on backing the currency with underlying asset pools to maintain its value. So it's quite safe. They consider it's quite safe with no associated credit or liquidity risk. But there are, of course, certain risks as well, and they spell them out too, that it might affect the financial sector market structure, and we do not precisely know in what form. It will affect the cost and availability of credit, the safety and stability of the financial system, and the efficacy of the monetary policy as well. As you probably mentioned, observe, they didn't really talk about cryptocurrency as a form of money, but they do devote a section to cryptocurrencies and stable coins, saying that cryptocurrencies is a technical innovation. These are digital money or digital assets with money-like characteristics. These cryptocurrencies arose from a combination of cryptographic and distributed technologies, and they provide a foundation for decentralized peer-to-peer payments. Cryptocurrencies have not been widely adopted in the US, according to this paper, and that's pretty understandable because they are volatile, they're difficult to use without service providers. So for ordinary person, they're difficult to use. They have severe limitations on transaction throughput, which is a very valid argument. Many cryptocurrencies also come with a significant energy footprint. There's a lot has been said about Bitcoin and its proof of work consensus mechanism, and make consumers more vulnerable to loss, theft, and fraud. They do mention stable coins as well as a particular innovation and a recent incarnation of cryptocurrency. These stable coins peg their value to one or more assets, such as sovereign currency, it can be a commodity, or it can be a basket of other cryptocurrencies. Stable coins, which are pegged to US dollars, are predominantly used today to facilitate trading of other digital assets, but many firms, many startups are exploring ways to promote stable coins for payments as well. The Fed are not very open about the technological experimentation that's going on because probably they're still undecided as to what design, what architecture a CBDC will have. So they continue to explore a wide range of options according to the paper, but they particularly focus on a number of characteristics that according to them, a central bank digital currency should have. It should be privacy protected, intermediated, widely transferable, and identity verified, according to the paper. The Fed is now engaged in a number of experiments related to digital currencies. Some of these experiments leverage existing technologies and systems. So the board's technology lab in particular is running a number of experiments. They're also exploring a design which could leverage new technologies, particularly DLTs and blockchains. And they are running a number of experiments there with the MIT Digital Currency Initiative. And of course, they're also considering the use of DLTs for wholesale payments and interbank settlements. This is where DLTs, distributed ledger technologies, can be used. Now, because they're not very specific on how exactly they're going to design to architecture CBDC, it's very good to go to actually the source of it and look at one paper that I found that's by Raphael Auer and Rainer Bohm. One of them, the first author, is from BIS, Bank of International Settlements, and it's called The Technology of Retail Central Bank Digital Currency. It's in the public domain. They've done a very good job at explaining how the three architectures of CBDCs might look like. The first one is what they call indirect CBDC, and that's a claim on the intermediary. Intermediaries onboard or KYC retail customers and handle retail payments. So the central bank will handle wholesale payments. That's the first architecture. The one that many people are talking about right now are the so-called direct CBDCs. And direct CBDCs are a claim on a central bank. This is how actually the Federal Reserve defines a CBDC. So intermediaries or central banks, so both intermediaries and central banks will onboard customers, do their KYC, and the central bank will handle retail payment. And then finally, there is a hybrid CBDC, which combines elements of both. CBDC is a claim on a central bank, or intermediaries on board and handle retail payments, and the central bank will periodically check and record retail balances. So 3 types, 3 architectures: indirect, direct, and hybrid CBDCs. In this paper, there are a couple of other very interesting points that they make, particularly which refers to the infrastructure and technology underpinning CBDCs. And this is what they're saying, because transaction throughput is a really real issue in blockchains, and will be a real issue for central banks as well. For the central bank, the indirect CBDC implies transaction loads which are similar to those of today's system. So no problem with that. But if you're considering the direct CBDC, that would require massive technological capabilities, according to the authors, because central banks will need to proceed a huge volume of transactions similar to any credit or debit card company. The hybrid CBDC architecture is more complex to operate than indirect, as the central bank does maintain retail balances. Nevertheless, it could be implemented at a scale using today's technology. So that's the technological commitments that some of the banks will need to do. Then they also very interestingly discuss whether the CBDC will be designed using the centrally controlled servers, as many banks are using them today, or they will be using a novel distributed ledger technologies, including blockchain. So 2 options here with technological platforms. And I found one particular observation by them very, very interesting. So that there are differences between a centralized server and how blockchain works. I have a special show dedicated to how blockchain works, and in case you're very new to this channel. So please go back and check it out. You will learn probably a lot of the differences between the two. And the problem, no, it's not the problem, but it's just a characteristic of any blockchain, is that it has many, many different nodes, sometimes thousands of nodes, because it is distributed, and these nodes have to agree on the state of the system, and that takes time. And this is precisely why the consensus mechanism has got certain limitations in a distributed, decentralized environment. It takes quite simply a very long time to confirm transactions. So just to give you a little bit of comparison, what Bitcoin, Visa can do 1,700 transactions per second, Ethereum does 30, and Bitcoin is even less. Ethereum 2.0 is claiming to be able to do 100,000 transactions, but this remains to be seen. So the authors make this interesting comment that the overhead needed to operate the consensus mechanisms is the main reason why DLTs have low transaction throughput than conventional architectures. Specifically, these limits imply that current DLTs could not be used for the direct CBDCs, except in very small jurisdictions, given the probable volume of data throughput. So clearly, the current technology, if we're going the distributed way, which also ensures privacy, cannot be had given the current level of technology. So for direct CBDCs, it's not going to work, at least not just as yet. Now, the Fed paper is not very explicit about risks, and I thought it will be interesting and very useful to know what are these risks that they don't talk about. Thanks to Finextra, they do outline these risks in a bit more precise way, more detailed way. Firstly, there is an economic risk, and the key risk here is inflation. CBDCs can be created at the press of a button and distributed widely, inflating the money supply without any corresponding increase in the GDP. And we have seen this with quantitative easing. Then there are operational risks related to outages and cyber attacks. To the if it's a centralized design, then there is always one point of attack. Financial risks as well. Financial risks here include exchange rate risks and high lending costs as well. But most importantly, there is also risk to human rights because it can be used as a tool of surveillance and control. Governments can put an expiry date on CBDCs, they can limit what you can hold, they can vary interest rates and prices depending on who you are. They can prevent certain purchases and automatically deduct fines, for example. So money could be made programmable. A combination of this CBDC and digital identity is a particularly high risk. When money is programmable, then use of funds may be conditional on some attributes pertaining to a digital identity. The government can simply directly control how you spend your money. And let's bear in mind there is absolutely no monetary reason to combine CBDC with digital identity. Are there any dissenting voices there, including in the US government? Yes, there are. Tom Emmer has just recently introduced a bill prohibiting the Fed from issuing a CBDC directly to individuals. And he explains it in a series of tweets and in other channels why it matters. So it's almost a direct verbatim quote from Tom Emmer. He says that any CBDC will need to comply or rather address a number of concerns. It has to ensure financial privacy, it maintains the dollar dominance, and cultivates innovation. So these are three principles underlying any policy, US digital currency policy. So, and he's saying that CBDCs that fail to adhere to these three basic principles could enable an entity like the Federal Reserve to mobilize itself as a retail bank, collect personally identifiable information on users, and track their transactions indefinitely. Not only does this model raise a single point of failure issues, leaving Americans' financial information very vulnerable to cyber attacks, but it could also be used as a surveillance tool that Americans should never be forced to tolerate from their own government. Requiring users to open an account with the Fed to access the United States CBDC will put the Fed, according to him, on an insidious path akin to China's digital authoritarianism. So any CBDC that needs to be implemented by the Fed, if they want to go that route, must be open, permissionless, and private. This means that any digital dollar must be accessible to all, transact in a transparent way on a blockchain, and maintain the privacy elements of cash. So, what are some of the key takeaways here and some of the things that you need to know and be aware of? I think every citizen, entrepreneur, and business person, particularly if you're working in the commercial sector, commercial banking sector, you need to educate yourself about CBDCs. It is, as a digital liability of the central bank, you will be holding an account directly with the central bank. When money is programmable, use of funds may be conditional on attributes of your digital identity. And suppose the government doesn't like you. Yeah. So I personally think that CBDCs, particularly direct CBDCs, so-called direct CBDCs, are very problematic in a free society. Thank you for joining me. Thank you for listening. I shall see you on the French next Friday at 2 p.m. Dubai time. And now it's time for some music.